The broadcast is now starting. All attendees are in listen-only mode.
Good morning, everyone, and thank you for joining us for our Iowa Finance Authority's Take Credit webinar to talk about our new 2014 Mortgage Credit Certificate Program. We're very excited to be offering a new allocation of mortgage credit certificate funding this year, and we're thrilled that you're willing to partner with us on making this possible. I'm Deb Hauk. I'm the Director of Single Family Production here at the Iowa Finance Authority, and with me today I have Sherry Crone, our Single Family Program Manager, and Beth Mahaffey, our Business Development Director. And the three of us are going to share in the presenting today, and we'll all be on hand here to answer your questions at the conclusion of our prepared remarks. Before we get started, though, I did want to just cover a few housekeeping items. As I indicated, we will be asking you to hold your questions until the end of the presentation. And when you do ask your question, we're hoping that most people will be able to ask their questions using their telephone. And if you are not dialed in by telephone and you think you might have a question to ask, it would be a good time to consider going ahead and using that audio feature on the GoToWebinar menu bar and follow the instructions. There's a phone number and a PIN to use in order to access the telephone audio. That will give you the ability to answer or to ask your questions and then pose any follow-ups you might have at the end of our presentation. And you may be able to listen through your computer monitor, the speakers and microphone, but it tends not to have as good a quality as we've learned from our other participants in the past. So feel free to do as you choose, but just know that our preference, and we have had much better luck with the telephone feature. At the very end of the presentation, we will have a slide that says we're open to questions, and at that time we will go through the list, and if you have your hand raised, clicking the icon on the menu bar again in your screen, we'll call on you and open your mic at that time. If you choose to ask a question through the chat feature, we will hold those until the end, and if there is additional time, we'll answer them at that point. But we may not get to them if time runs short or we have other technical concerns. So at that point, if there were any unanswered questions that were posed to us through the chat feature, we'll just be following up with you by email or including them in a frequently asked questions posting later on. I just want to say, too, that this presentation, or a very similar version of it at least, is already posted and available on our website. So if you go to the information for lenders on the iowafinanceauthority.gov website, and you click on the Take Credit program under Forms and Resources or the Resources area, you can find the presentation. I believe it's dated the 28th. That was the first date that we offered this. We've made a couple of small tweaks to this presentation, and we'll be posting the updated version of it later today. But what's out there now is possible for you to print and use to follow along, and should be very close to what we're going to cover today. So today we have a fair amount to cover. I think we'll be able to keep it all within the hours, including the hour we've reserved, including the questions you might have. So we'll keep moving along. The agenda we have is really to give you a very basic overview of the program eligibility for financing, homebuyer, and property to be used with the mortgage credit certificate. We'll talk a little bit about the process for applying and getting approved for the certificate. And then we'll talk towards the end about the participating lender responsibilities, which are somewhat unique to this program, and the fees and compensation that can be used as you administer the program. And then at the very end, we'll go through the Lender Online lender portal that we use for you to reserve funds and upload program compliance documentation for us. And we'll give an overview of that as well at the end, and then open it up to questions after that. So to start with, we just want to give you the latest on where we are with Take Credit funding. So we are going to be opening the system for reservations on February 3rd, as we indicated in our announcement. And it will be open only for those lenders that are current Take Credit participating lenders. Most of you remember that we offered this program last year, and in the last year we served about 950 home buyers. We used over $202 million of capacity for the program. This year we have a smaller allocation. It's about $75 million this year. And all the funds that we had available last year were used by May. So just to give you a sense of sort of demands that we saw in the recent past, we're going to have a fair amount less resource here, and we do expect it to be in high demand. So We will be offering it on a first-come, first-served basis through the reservation system and allocating it accordingly. So we do expect that to the degree we have demand we can't serve, we'll be posting announcements about how you can keep tabs on that. But we do have, even though I don't think we'll need it, this allocation, we do have until the end of 2015 to use it. So, so we have 2 full years before it will expire, and I think we will have no trouble using the $75 million for 2014 by that time. Why do we offer this program? It is provided for in the Tax Reform Act of 1986 and by the IRS. It is to offer a federal income tax credit for borrowers that are qualified that lasts for the life of the mortgage or up to a maximum of 30 years, and also it's capped each year at no more than $2,000. So that's the benefit, the dollar benefit to the borrower. The way that it's actually, the amount that is actually taken as a credit is based on the amount of interest paid, the mortgage interest paid in a given year. And in this case, our program is going to be fixing that percentage at 30%. So it'll be 30% of the mortgage interest paid capped at $2,000. And depending on a borrower's individual tax circumstances, you know, whether they can take the credit or not will vary, but that's the value of the credit to a borrower in a general sense. The program does allow for, under the IRS guidelines, there to be some transferability at sale under very limited conditions, primarily only in the instance of an assumable mortgage that is assumed by another qualified borrower. And in that case, you could request, or the borrower could request, that the certificate be reissued to the new homeowner, and then the benefit could continue for the balance of the 30 years maximum eligibility. So there is a way of transferring it at sale, just to be aware of that. And the other thing, though, that is more common is that the mortgage credit certificate can also be reissued when an existing loan is refinanced. And so that's, again, an instance in which it would need to be requested to be reissued by IFA, and but can be done and would continue to extend that benefit to the qualified borrower today. So how does the borrower get the credit? Well, first, they do have to finance their mortgage through a take credit participating lender. And the financing does have to close in the name of a participating lender. So for those of you that close in the names of other people or that kind of thing, you're just going to want to be aware that that's the criteria that we're going to be using to determine whether this is a qualifying mortgage. So first, they have to finance with a participating lender in the program. And then the lender will collect all the required documentation of eligibility and submit it to IFA, along with any fees that may be due. And after the documents have been reviewed and approved, IFA will be issuing the certificate directly to the borrower, an original document that goes to the borrower after closing. A copy of that document will also be sent to the lender, confirming that the certificate was in fact issued. All of the final approvals are done post-closing because we do have to validate that the closing occurred as it was described prior to. So we do a pre-close review, but it's not finally approved until after we've been able to confirm that. And that's then when the final certificate would be sent out to a borrower. And then after the borrower gets that certificate, they can use it as the documentation they're relying on in order to claim the credit in their taxes at the annual tax return time. So program eligibility falls into 3 different categories, which we'll go through in the next coming slides. They're, as we've defined them here, just we'll talk about what kinds of financing can be used with mortgage credit certificate, what kind of borrowers qualify for it, and then what kinds of properties can be purchased and financed with this associated mortgage credit certificate. So first we'll start with eligible financing. And this is a pretty easy one, actually. It can be financed with a Homes for Iowans first mortgage, also financed with the PLUS grant, including the PLUS grant as possible, or the Military Homeownership Assistance Grant. The entry cost assistance programs can be layered with this program if you're using a Homes for Iowans first mortgage. But then it's also possible that a lender could offer another 30-year fixed rate financing. So as long as the financing being used to purchase the home is 30-year fixed rate and fully amortizing, it can qualify for the mortgage credit certificate provided all the other conditions are met. But it is important to also note that if you do the Homes for Iowans, you can layer it with our down payment assistance, and then there's a very rich benefit potential there for borrowers that qualify. In particular, those that qualify for both the PLUS grant of $2,500 and the military homeownership assistance grant of $5,000. These are borrowers that are extremely lucky to get that kind of a benefit. And then just on the flip side of that, I want to just highlight for you what cannot be used with the mortgage credit certificate in terms of financing. And what cannot be used is the IFA First Home program or the First Home Plus program. And the reason for that is that the part of the IRS guidelines that provide for the mortgage credit certificate and the funding for it are exactly the same as those that provide the tax-exempt financing that we use in our First Home program. And so, in essence, the IRS considers it double dipping. And so it cannot be used with the First Home program. Not to be confused with the fact that it applies all the same eligibility criteria virtually as our First Home program. But it's basically an either-or proposition. You can either use the First Home First Mortgage, or you can use the mortgage credit certificate. And fortunately, IFA has another first mortgage financing option available within its Homes for Iowans that is not funded with tax-exempt bonds, and so we do have another option now at this time. But just to be clear, it cannot be used with First Home. So if you do make a reservation and accidentally select a First Home option, we would probably be contacting you and asking if you'd like to switch that to the Homes for Iowans program. The other thing, obviously, because it does need to be a 30-year fixed rate, fully amortizing, we would not accept an adjustable rate mortgage or any kind of financing that is not fully amortizing. So moving on to the next category of eligibility, we'll talk a little bit about what is required to be an eligible borrower. And in general, as I said, it's going to follow right along with what you're used to and seeing in the First Home program, the typical first-time homebuyer program, which is that you have to be a first-time homebuyer, which is defined as someone who has not owned a primary residence in the last 3 years, or you need to meet one of two exceptions to that requirement, which would include being a military veteran, discharged other than dishonorably, with no previous use of a mortgage revenue bond program, or be a family that's purchasing a home in a targeted area. And sometimes we get the question, what are targeted areas? Those are listed on the income limits table that you can find on our website. There are more of them this year than there have been in the past, so just be sure to double check that if you're looking at it. But that's a way that you could qualify without being a first-time home buyer. And then the second category of home buyer status that has to apply, of course, is the income eligibility. So again, referring to the income limits table, which we'll talk a little bit more about in the next slide. The borrower needs to fall below or at or below the applicable income limits for their situation. The other thing to just keep in mind on borrower eligibility is that they need to be intending to purchase the home as their primary residence and for immediate occupancy after closing. So that's not really listed here, and it's kind of, I think, something we've assumed, but just to be clear, it is only for that, not for a vacation home or an investment property. So how do you prove to us that the person meets the homebuyer status? In order to prove the first-time homebuyer status, you're going to want to submit the last 3 years of federal tax returns. If the current address of the borrower is different from the last tax return, you're probably going to need to furnish us with some verification of rent. And if there's been a divorce within the last 3 years, we'd want to see a copy of that divorce decree as well, just to ensure that no incidental property ownership was implied as part of a marriage situation. So those are the kinds of things we'll be looking for. These documents will appear on a checklist or a transmittal form that you'll be able to access in our Lender Online as a program form for your reference, but that's what they're for. They're to help us ascertain whether or not a borrower qualifies as a first-time home buyer. If the borrower is not a first-time buyer and they're going to want to qualify as an exempt veteran, then you would need to provide the DD-214 discharge status. And then the borrower will also have to certify that they have no prior use of tax-exempt financing, and that will be done on the MCC-01 form, which we'll talk again about a little bit later. But that's another form that we prepare that you have a borrower sign. So borrower income eligibility is determined at the federal level. It's set annually for each county by household size, broken out from 1 to 2 person households or 3 or more person households. And as you can see below, what I've listed there is just the range. These are actually set by county, so you will have a number for each household size for the county in which the buyer is purchasing. But this is just to give you the ballpark range of household incomes that can be approved in the program, and so you have some idea of what population we're talking about in terms of incomes in those household sizes. The actual amounts you would find at that link, which is shown in blue above the table. And you can get, that will take you directly to our income and purchase price limits table on our website. Income is defined in some federal regulations basically as all family income projected for 12 months. And in IFA's case, we look just at the income of the borrower, the spouse of the borrower, and any other title holders or spouses of any title holders that would be included in the financing. So that's the income we're going to look at. In the past or in other places, you may be familiar with agencies that look at all the income of all household adults, and we've chosen to define it a little more narrowly to just include borrower, spouse, and title holder and spouse. So that's just to be aware of. And then, as I said, it's 12-month projected. It's into the future, just so you know. We are, under our regulations, we're looking ahead. We may look at the past to make a projection of the future, but our goal is to see what will the income be, or to determine best we can, based on the information available, what the income will be for the 12 months following the closing, not what it was in the 12 months prior. So we may ask you questions that sound kind of strange, but that's why. And then we will be including all court-ordered income, even if it's not received. And now this will be different, you know, in many cases from what you may be doing in looking at underwriting income, because you're going to be looking to see, do they have enough income to support their debt or their debt service. And in our case, we're looking to make sure that we're in compliance with the guidelines. So we're going to be looking more generously at their potential income, and to make just extra careful sure that we're not putting someone into the program who really has too much income to qualify, and then we could get have an audit finding from the IRS by doing that. So we're looking at it a bit differently, but we will primarily be looking at a lot of the same items, just with a little different eye towards it. So what does income include? It's really the things that you probably know about: wages and unemployment, child support, alimony, public housing assistance can be included. Income from assets is included, would include any interest or dividends. Scholarships and college grants that are not restricted to tuition and books may need to be documented, or will need to be documented. And special armed forces pay, including housing, rations, and uniforms. Income does not include any scholarships or grants that are restricted to tuition and books. It does not include combat pay, and it doesn't include a lump sum payment, such as an inheritance. How do we verify income? Again, these are going to be similar to what you would use in verifying income for any other purpose. It would be the W-2s, tax returns, verification of employment in some cases, and pay stubs. For a non-working person, we'd be looking at a 1010 warning statement. We also may require the past year IRS transcript with no record found to show the history. And we would also accept current award letters when we're talking about folks with incomes from various pensions or benefit programs like SSI or Social Security Administration. We'll look at award letters for grants and scholarships as well. We will want to see child support stipulations and any divorce decree documentation that may be applicable. And then for additional income, we'd look at the 1099 typically. Moving on from borrower eligibility to property eligibility. This also is a relatively easy concept. If the purchase price or the acquisition cost of the property is less than the applicable limit, as I've indicated below, then the property can be considered eligible per this guideline. So we have two different property purchase price limits, and they're based on whether your property is located within a targeted area or a non-targeted area. And as I mentioned, the targeted areas are by census tract. They're shown on the income limits table, and you can just double check that at the time to see which applies. But generally, if they're under if the property value or acquisition cost is under $250,000, it's going to qualify no matter where it is. So how do we look at acquisition cost? We do look at all the costs to acquire the property, which would include in-kind or seller benefits such as non-tax proration, the purchase of personal property for greater than fair market value, and cost to complete the home, excluding buyer labor to complete the property, and the cost of a lot if it's owned for less than 2 years. And again, the acquisition cost that we total up from all of those factors would need to be less than the purchase price limit. The way we're going to verify that is we're going to take a look at the purchase agreement and all the addenda, and we will require evaluation of any personal property that's been included in the purchase agreement. And there are some instances in which we see people realizing that they don't want to have to submit additional documents, wanting to have people agree that personal property should be struck from the purchase agreement existing, and we really don't consider that. So if you, after the fact, go in and adjust that purchase agreement just to cross off the personal property reference and initial it, we're not going to really consider that as valid. We're just going to still require you to value the personal property and then make sure that there are funds from another source in there to cover that besides the financing that's eligible for the MCC. So just be aware that any time it's been listed on the purchase agreement, it's going to have to be documented, and it's not a difficult thing to do. Typically, we can advise you on that offline, but we're not asking for, in most cases, a very complicated step here. But we just want to make sure we cover our bases, and that's an area that you may find some confusion, and we've seen that happen in the past. But just contact the person, your primary contact, and work through it with them. That's the best thing to do. And again, we'll need documentation of any cost to complete the project, and for new construction, documentation of the lot purchase if the cost, if it was owned for less than 2 years, and we will be looking for an appraisal. So with that, I'm going to turn this over to Sherry Crone, our program manager, and I'm going to have her take the next few slides to talk a bit about the process for the program. So Sherry, if you could walk us through that, that'd be great.
Well, good morning, everyone. This process is relatively the same process that you would follow if you were using the First Home or the Homes for Iowans program, and also extremely similar to the process that we used last year for the MCC program as well. So the first thing that you're going to do, obviously, is to take a loan application, have a discussion with the borrower, and ensure that they are first-time home buyers and qualify for the MCC program, check the income limits, purchase price limits, that sort of thing. Then you are going to reserve the MCC in Lender Online. And if you are using the Homes for Iowans program, you're also going to reserve the Homes for Iowans program in Lender Online at the same time. There are 2 separate reservations required for that. At least 5 business days prior to closing, then you are going to upload the compliance review package to Lender Online. At that same time, if applicable, you are going to send the $300 borrower application fee to IFA. Now that requires some clarification. The $300 borrower application fee is only required in the event that a lender is not using the Homes for Iowans or Homes for Iowans Plus program. So if you are using an IFA First Mortgage program, then you do not need to send that $300 borrower application fee because that fee is waived in that event. Once IFA receives your compliance review package, we will review it as soon as we possibly can. We do ask that you give us at least 5 business days for that review. Then if there are any conditions related to eligibility for the MCC program, we will ask you to satisfy those conditions before we issue notice of commitment. The commitment is required to be in hand prior to closing the loan. In addition to that, if the $300 borrower application fee is necessary and you're not using an IFA mortgage product, we do need that funding in-house before we are able to issue the commitment to you. Once we issue the commitment, you are free to close the loan and then upload the closed loan package to Lender Online electronically within 30 calendar days of close. We will then conduct our post-close program compliance review, and if all is satisfactory and eligible, then we will issue the mortgage credit certificate to the mortgagor, and we will provide a copy of the notice to the lender. Just a couple of tips we'd like to share. As we mentioned earlier, the MCC is a separate reservation from the First Mortgage and Lender Online. If you are used to looking in Lender Online, you know that there's a series of numbers that make up the IFA reservation number. If the first three numbers of that reservation are 160, then that means it's the Homes for Iowans reservation that you're working with. And if it's going to be 801, then that will be the MCC reservation. So just to let you know that, sometimes it's helpful when you're uploading packages and make sure you're uploading the right package to the correct reservation. The reservation expires after 60 days, and we will be watching those dates and following up on those because the funding is so limited in the program. Just a reminder that we do not look at underwriting. When we are reviewing files, we are looking for program eligibility only as far as the Iowa Finance Authority is concerned. So you do need to follow agency guidelines with respect to loan type. So FHA, VA, RD, Fannie, whatever the case may be. The commitment notice that we will issue, again, you must receive prior to closing the loan, and it does expire after 60 days. And we ask that you check the commitment to make sure it has not expired prior to closing. If it has, then you need to contact your loan production specialist to ensure that we still have the funding available for that borrower. Okay. Post-close tips. The funding is limited, as we have discussed, so the commitment may be reduced if the lender doesn't upload the post-close package in a timely fashion or provide conditions that we may need before we issue the certificate. So just be mindful of that. If the loan amount changes after we issue the commitment, we do ask that you contact us to get that loan amount changed in the system. And if it's higher, then we need to ensure that there's still funding availability for that program. Obviously, if it's less, we want to release that funding to other potential borrowers. So you can do that by completing a loan reservation change form and uploading it to the MCC reservation, which we'll start with 801 in Lender Online. And the only other tip that we have for you is that you educate your borrower to make sure that they get the full MCC benefit and that they understand what the program parameters are and will benefit from them for many years. I'm going to turn it over now to Beth Mahaffey, who will go through the benefits and some of the tax implications.
Good morning. This slide we're going to walk through is just a very, we use very simple examples. So I'm just going to walk you through this real quick. What we've done here is use a loan amount of $105,000, 30-year loan, obviously, because that's what it has to be, at 4.5% interest. And $105,000 was our average payment size last year. So in this instance, the individual is making or has income of $50,000, and their mortgage interest deduction, which by that we mean the annual mortgage interest paid, which would come to an individual, as you know, as lenders on the Form 1098. The taxable income ends up being $36,100, and then the taxes due, or the liability, is $5,230. So at this point, all variables are the same. This is when, after the liability has been calculated, this is when the tax credit comes into play. And I'll also show you an example of this on a tax return. But in this instance, because the annual mortgage interest paid was $4,725, you would take that times the 30% credit, and that amount is the $1,417. Obviously, if they had paid significantly more mortgage interest, they are capped at that $2,000 max per year. In this instance, you can show your borrower that with the mortgage credit certificate, their liability is reduced by the $1,417 to $3,813 in comparison to the $5,230. I'm going to use these numbers and show you an example on an actual Form 1040. Okay. Okay, here we go. So on this 1040, this is one individual with one dependent. Again, there's the $50,000 in income. So in this instance, they do not have the mortgage credit certificate. And I also wanted to mention we are assuming a standard deduction with this example. If the individual was able to itemize, they could take the balance of that annual mortgage interest paid and they can use that as an itemized deduction on Schedule A. Some people have asked in the past, well, I already get to take my mortgage interest paid on Schedule A, so why is this mortgage credit certificate a benefit? This is a benefit because it is a dollar-for-dollar reduction in that liability. It is calculated at the end of your tax calculation and is offset against the tax liability, whereas if you're taking that mortgage interest deduction as an itemized deduction, that is just at the percentage, ends up being at the percentage of the tax liability. So this is a much greater benefit with a mortgage credit certificate. But that being said, the individual still can take the balance, or in this case it would be 70% of that mortgage interest paid for this year as an itemized deduction. So in this example, again, there's no credit for the mortgage credit certificate. So the individual does have withholding, which I wanted to represent because some of your borrowers may get confused about the difference between withholding and how that affects their credit. It really has no effect on their credit because this offsets against the liability. If they have withheld and the mortgage credit certificate reduces their tax liability, they may get more money back. But other than that, there is no effect on the withholding. So in this instance, with the tax liability, as we mentioned on the earlier slide, of $5,230 and no credit for the mortgage credit certificate, they have withholding of $4,000. So this individual would end up owing $1,230. Now if we go to our example with the mortgage credit certificate, again, same information, same income. But as you'll notice on line 53, we have broken is, again, that mortgage interest paid for the year times the 30% credit that we have set this year, and that's where the 1,417 credit is calculated. As you'll notice on this form, there are lines for credit carry forwards from earlier years, and if you go down further, there is the ability to calculate any leftover. That is why there's, if by chance we had a credit that was bigger than that, obviously, as I mentioned, we wouldn't be able to take that. But in this instance, because it's 1,417, we aren't limited, and we can take the full amount as a credit on the Form 1040. So back on the Form 1040, we've taken that 1,400. This mortgage credit certificate is not a refundable credit. So if your individual wouldn't have a liability, as I said, they can carry it forward, but they won't get money back based solely on the mortgage credit certificate. It is not a refundable credit. All right, I'm going to pass it back to Deb now, and let's see.
All right, thank you, Beth, and I hope that was useful. And I just want to make a note that these examples will also be available in the same place where we post the presentation, so that if you wanted to have them on hand when you meet with borrowers or share them with borrowers, you're welcome to do so. And they are out there. We had some examples from last year as well that are out on our webpage. So might be included. And as you know, like I said, these are this program is mirrored and covered under the same part of the IRS guidelines that deal with mortgage revenue bond program. So we have, in that instance, we have MRB docs that most of you are familiar with. MRBs 1, 2, 3, and 4. But for the MCC program, we've shrunk that down to 3. So we have MCC 01, 02, and 03, and they are listed here. They are very much along the lines of what you've seen in your other documents. So there's an affidavit of purchaser, which does indicate that the borrower understands that they are certifying as to their status as a first-time buyer or other qualified status, that they are certifying that their income is within the limits and that the purchase price also falls within the limits. Then the recapture notice is the other required thing, and in fact, yes, recapture does apply to this as it does to our First Home program. The one difference with recapture here is that in the First Home program, we put out a notice and have honored the note that we would reimburse a borrower who closed on a loan after a date and time of, I believe, November of 2012? 2011. That if they were hit with recapture tax and they closed on a First Home program mortgage, that we would reimburse them. But we are not offering that same extension of benefit to the Take Credit mortgage credit certificate borrowers because in this instance we don't really have any ongoing revenue from the benefit that they're receiving in which to fund such another commitment. So with recapture it will apply, but we have found historically that it very seldom comes up because the conditions under which it comes up are so narrow and limited in scope that it is very rare that it ever hits a person who's benefited from one of these programs. So, but the MCCO2 is required nonetheless because of the IRS guidelines, and the seller affidavit is also required to validate that purchase price and the transfer of an eligible property. There are also some overarching reporting and record-keeping requirements that are transferred to the lender through the participation agreement, which all of you that are signing up are signing and executing for us. And they're not very extensive. To be clear, there's one form that gets submitted for each year in which you are issuing certificates. So last year you would have had to submit one form for the certificates that were issued in 2013. Those would have been due by the end of this month. It's the 8329 form, and I'll have Beth go over that in a few seconds here. But the other bit of record keeping that's required are these items that are listed below, and in essence all of that information is contained on the copy of the mortgage credit certificate that you will receive for each borrower. So as long as you keep a copy of that certificate somewhere in your records, you will be maintaining the required record of this transaction. So you retain that for 6 years, and that's the extent of it. So I'll have Beth review the 8329 form for you quickly, and maybe that'll help those of you that either haven't submitted yours yet this year or are haven't done it before. So.
All right, we are going to jump down to the 8329, and really one of the reasons we wanted to show this to you, well, twofold, and I think as Deb mentioned, there will be there's an example of the 8329 for Take Credit 2013, and then this one will be listed out there as Form 8329 for Take Credit 2014. So this one won't be due for the MCCs that are going to be issued this year. It won't be due until January of 2015. Now for your last year's mortgage credit certificates, this form is due January 31st, 2013. So, and it will have a different bond amount. That, as you'll see on this one, it's $74,464. This is for, again, the MCCs that are going to be issued this year. So the one you'll be looking for if you're completing this form today or tomorrow will be the 202. So, and again, we'll have them listed separately. If you have any questions, please let us know. But we really just wanted to show this to you to let you know this isn't a very intense form. There's only this front page to it and then a page of instructions. And really the lender would just fill out their information and then the individual recipients of the mortgage credit certificate. And that information, it comes directly off of the mortgage credit certificates that we will be sending a copy of to each lender as we mail those out to the individuals. So that information is all available on the actual mortgage credit certificate. And then the information that you would need from the issuing authority, which is the Iowa Finance Authority, is available right here. So this will be posted on our website, so you can obtain it there, or you can always call us if you have any questions or email us, and we'll get that information to you. But again, this form only needs to be filled out in that first year of issuance. You don't have to fill it out for 30 years for each of these individuals. So, and again, please just check and make sure you've grabbed the right bond issue amount. So, Deb, did you want to add anything to that? And as you see, it's just one page, and then a page of instructions. And so please just let us know if you have any questions for that. Everything should be available to you on those mortgage credit certificates.
Great, thank you, Beth. And we'll transfer it back, hopefully with not much delay.
Yep, there we go.
All right, thank you. So the next topic on our agenda are the fees and compensation that are associated with the program and what kind of limitations and restrictions are applicable there. I'll start with the left-hand side of this, which are the borrower fees. And first we'll talk about it. Just depending on how the state agency sets up their program, that it happens in our case to coincide with the financing. But in some states, the program is done retroactively for closings that occurred in the past. And so in that instance, a borrower or a lender may be charging that fee completely outside of the closing process, and that's not restricted under the regulations. It is restricted in the IFA program because our policy is using the program to incentivize new purchases. And so we're making sure that we're approving it and collecting that stuff on the front end before closing. But it does confuse people sometimes because then they think of it as a closing cost when in fact we don't believe it really is. So I know I'm spending a bit more time on this than maybe some of you are interested, but it's been a point of concern and contention given all the new restraints on lenders and their compensation for financing in the Consumer Financial Protection Bureau rules and things like that. So we're just giving you the best explanation we can of how we stand on this issue. But with that, I will say that the $200 fee for processing it may be necessary because as Sherry mentioned earlier, there are 2 separate reservations, and we are really treating this as a standalone benefit. So you're going to have to do some repetitive work here because a lot of the same documents may need to be attached to a separate transmittal form for the MCC. Because if you want to finance this with an IFA mortgage, which we certainly encourage and appreciate you doing, if you use the Homes for Iowans package, you're going to have a checklist or a transmittal form, and you're going to attach certain documents in a certain order that associate with that. Some of those same documents will probably be on the list of the transmittal for the MCC, but you're going to have to reassemble them with that other transmittal and upload a second package. So you are going to be duplicating some effort here, and we acknowledge that by allowing you to charge this additional fee to cover those costs. So it's work, and yes, we understand that, and we'd like to be able to do it more efficiently, frankly, than that, but our system, our technology does not allow for that. So that's what the lender fee is for. There is also an application fee, a borrower application fee of $300 that we're expecting to collect from the borrower through you, that you'll get from the borrower and submit to IFA. And that's going to be waived if an IFA first mortgage is used. So you can just see here, $300, as Sherry said, for non-IFA financing needs to be submitted with the pre-close compliance package. Or if you are going to use an IFA first mortgage, you do not need to worry about that fee. You just need to reserve the Homes for Iowans and upload that information to us. So that's the borrower side. Now I'll move to the right-hand side and talk about lender sign-up fees. The fees for lenders to sign up are a little different this year, and many of you maybe have already done it, so I'll just be very brief, but it's $200 as opposed to $100 for each company to sign up, and then it's plus the additional $100 per branch, which was also there last year. The $200 is the amount that we're charging to the lenders that participated in our first mortgage programs, who we refer to as our IFA participating lenders, in 2013. So anyone who was signed up with our program last year as a participating lender will get the $200 fee. For those lenders that do not work with our first mortgage financing programs, we charge a fee of $500 per company, and again, plus the $100 per branch. One note in red that I put on the bottom here does pertain to those borrower fees. Because, as I've stated, it made a great pains to go point out we aren't considering those to be closing costs. They're not costs that we see as incurred as a condition of the extension of credit. So they don't constitute closing costs, and therefore they are not an eligible expense to be reimbursed with IFA's entry cost assistance grant programs. So if they appear on your HUD because you've determined from your eligibility side that you want to put them on there to be safe or what have you, just know that if you're using that IFA grant, you're going to need to have other funds to cover that cost. We won't be covering it with the grant funds. To sign up as a participating lender for Take Credit is very easy. We just need you to email us a sign-up request form, and we will then shoot you out a customized invoice for your sign-up fee and a new agreement to be executed for 2014. That's very easy, and you can access all of that sign-up request form on our website, as well as the program guide and other information that you may need. With that, I'll turn it back over to Sherry, and she's going to give us a quick overview of the Lender Online system, and then we'll open it up for questions after that.
So if you are a new participating lender, then when you sign up for the program, we will give one individual in your office system administrator access, and then that person will be responsible for setting up other users and other roles in the system. So assuming that you have a username and password, you log onto the system. And this looks just a bit different than what you will see, simply because I am the administrator for the program, so you'll see a few less tabs here. But to make a reservation, you are going to click on the new reservation tab. And when you do that, you will see the ability to make a reservation for the Mortgage Credit Certificate program here, and you will see the opportunity to make a Homes for, and then also the Take Credit down here. So if we were to select Take Credit 2014, we're going to make a reservation. It's going to take us to the reservation screen, which pretty much mirrors a 1003. The main difference on this screen is the fact that the income is actually listed as annual income as opposed to monthly income. So that's one important point to notice here. If you don't put annual income in, you will not receive the system benefit check of totaling your income and checking it against those program income limits. So any field that has a red asterisk is a required field, so you will be required to fill all of that information in. And then when you get down to the bottom of the screen, you can hit the Submit button, and the Submit button will either make a reservation for you, or it will give you a series of error messages that you will need to fix before the system will actually accept the reservation. Once you accept it, or once you fix all of the errors, if you get any, then your reservation will be made, and you'll get a message that says your reservation has actually been accepted. From that point forward, you will do all of your work in the loan status screen. And the loan status screen lists every borrower as well as every reservation. And so you can see here that we have a borrower called Mr. Testing. He is our testing file. And you can see here the reservation numbers that I referred to earlier. If it's a 100 series, it's a first home reservation. 160 for Homes for Iowans. 801 for Take Credit. 300 for military. So once you find your reservation that you need to do work in, you will have 4 action buttons on the left-hand side of the page. The View button will simply allow you to view information in the reservation itself. The Reprint button will reprint the reservation for you. Some lenders like to put that in their file. The PDF Docs button will generate the form that you potentially need for the loan, depending on loan type. And if you use this version, it will pre-fill for you as much as it can based on the information that you input into the reservation when you made it. And the eDocs button is actually where you're going to go to do most of your work. And that is where you are going to upload a pre-close package, or on the left-hand side of the page, a post-close package. So to do that, we would select the button that says Add New. And we're going to click here to upload a document. We're going to browse, and we're going to find where we have saved it on our computer. And see if I can find a document. Select the document, select Open, Package, and you're going to save. When you save, you're going to get another message that says it's been successfully saved, but you're not done with your work yet. Now you come back out here and you can see that the submit button is active, and you use that submit button to update our internal software with your submission. If you do not use that submit button, you risk delay in review because we may not know that the package is out there, and we may not be able to review it until you notify us of that fact. So just be careful that you use that each and every time. Same process over here on the post-close side. And then up here at the very top, you see another series of menus. If you're ever lost in the program and you can't find where you are, you come back to home. Bulletin board is where we list all of the information, bulletins, rate changes, that sort of thing that we send out to lenders. Program documents is where we list all of the documents that you will potentially need for a program. The same documents that are located here are also in that PDF docs button in the loan status screen. But here in program documents, they're generic, and they will not pre-fill for you based on that reservation information. So if you want a blank form that you want to print and fill out by hand, or something that you want to save, you would access it here. Servicer documents, there's not anything in there right now. There may be at some point. Marketing materials just takes you to our website. And glossary is a glossary, obviously. We do ask when you log out that you log out up here in the right-hand corner. And with that, that is the end of the Lender Online demonstration, and we'll open it up for questions.
All right, thank you, Sherry. It'll take us a minute here to go and identify who might have their hands raised. So if you have a burning question and you haven't indicated that, go ahead and check the question and raise your hand for us. We can call on you when we get back to our GoToWebinar. Okay, looks like we have a question from Christy Hewitt. Christy, we've unmuted your mic if you'd like to ask your question. All right, we are unable to hear Christy. So we'll move on to the next questioner. Okay, Holly June, we have unmuted your mic, but I'm not sure that you're live. Do you have the ability to ask your question at this time? Okay, sorry, Holly. Sounds like we can't get to you right now either. It seems Karen Wright also has a question in Holly's case as well, that you are attempting to pose a question with not being logged into the telephone version, as I had indicated at the outset of the presentation. So if you want to go ahead and try to call in, go to the audio portion of your menu, and there's a phone number and a PIN there. It may not let you for very much longer because our session will end in a few minutes. But if you can get in, dial in that way, hopefully we can hear your question that way. And I think those are all the questions that we had logged for now. What we'll do, it's like we're at the end of our time anyway at this point, so what we'll do is encourage you that if we did miss any of you or you had questions you weren't able to ask for whatever reason, if you just want to send us an email, all of our information is on the last slide of our presentation, which is posted. And we'll just pull it up now. Just go down to the last one. There. So all of our email addresses are here for you, and you can certainly just email us your questions, and if we see a common thread, we will probably post a frequently asked questions out there on our webpage, or we'll respond if it's a unique to you kind of question just directly to you. So thank you so much for your time, and we look forward to working with all of you to get a great benefit out to Iowans